All right, guys, welcome back to another episode of Chart Talk. Pretty crazy last week. So with that being said, we'll jump right into it. Again, Q's very textbook price action we've seen lately, just a very broad bull flag that's been forming. Again, we had this, massive, give me a moment. We had this massive breakout stage for many, many months of pretty much the second half of all of 2025, going into 2026, from the, October until the new year, we've basically been forming a big bull flag at highs. You can call this a topping pattern, call this a, bull flag, but the market is just digesting this massive run up. We had the little tariff crash, we had the recovery, rally to new highs, and now we have this broad consolidation. So what we were highlighting last week was we had that perfect retest of the prior all-time high, which, as we should be aware, that's often met with resistance. So it got back to that prior all-time high. It retests. People look to take profits. Again, if anyone that was buying in this flag the last couple of months, and it's never pretty higher than this area just creates resistance. People just want to sell into that. So it's not a really big surprise. We're in names that are retesting. We do look to sell into these retest areas because you throw a limit sell order at the prior all-time high, very easy, not easy, but the odds are you'll get taken when it gets up there. So still setting up eventually as we continue to form these higher pivot lows, we're seeing buyers stepping up week after week. And then the sellers are very clearly at this 630 area. So eventually one or two of these has to break. Either is the breakout higher or this will be a confirmed topping pattern and there's that breakout lower. But the good thing is as these buyers continue to step up, I'll change this to red. The risk, in either direction gets tighter and tighter. So you don't have to give the risk first 580. If this range is 10 points here, you want to see the breakthrough here to add long or break below here to raise some cash and be more defensive. So S&P, very similar price action and not as horizontal as the Qs as defined as that flag. Again, we've seen this breakout stage continue since May, where the Qs kind of topped out a little bit earlier and started to consolidate more horizontally. S&P is still just kind of in this breakout stage, but we are getting extremely tight at this 700 area. So eventually either it has to be, a break through 700 to new all-time highs or a break below this like 680 area. And then we maybe roll back over to like the 650 area. So overall, given what's been going on in the market outside of stocks, silver's getting destroyed, gold's getting destroyed, a lot of crypto names are getting destroyed. Market's not caring. So it's, there's kind of two sides of the coin. There's the one side that with all these other asset classes getting really beaten up, that if people leave those asset classes and go to the boring stock market, that could be the catalyst to push it through all-time highs. And on the flip side of that coin is with everything getting destroyed, the market being the last one holding up, eventually it kind of pulls it. So either way, again, I'm not really trying to pick a side. We just focus on the price action. So for now, it's really just expecting some sideways action, some very tight price action. And the S&P was in a 0.5% range today. It's very insignificant compared to what we've been used to. So break above 700 in the SPY, great. Break below 680, be a little bit cautious. But really, 650 is the key out in this market. So we have a lot, when you have a boring market, you have very clear defined exits. When you look at things like gold and silver, when you have these parabolic runs, once you get the first really big down day, the move gets negated before you can think twice, because there's no support, where the market has just been inching higher slowly over this past year or so, year and a half. These very slow, almost boring incremental increases. Some people that have got trapped in silver or gold this past couple of days probably are hoping or wishing for that boring price action. So again, even the Dow, again, very clearly still within this broader bullish channel. Again, resistance, this red line, support, the green line, again, visually as simple as possible. Nice little flag forming here. A lot of the larger cap names have been a little bit stronger recently, where we've seen a lot of weakness in the high beta names. A lot of the tech and like software names have been a little weaker, where some of the larger cap names, Walmart, for example, McDonald's, another example, looking, very strong lately. So it's kind of a shift towards the less riskier assets seems to be the move overall. Again, last week we had, the US dollar retest macro support. Again, big, bear flag overall for the dollar. Again, weak dollar. It's good for equity prices. And we had that little retest of macro support last week, little bounce off it. But again, we're just seeing lower lows, lower highs. And again, weak dollar, good for good for stocks. So moving on to some sectors, again, semis, strong as can be, except for our big friend NVIDIA, who's kind of like playing, kind of asleep at the wheel compared to a lot of the other semiconductor names. Industrial, super strong, broke out of its bullish channel, formed another very tight bull flag at all-time highs. So just waiting for that breakthrough, this 325 versus 317. Again, definitely keep an eye on the industrial names, very strong here. Materials, again, with the market, when you can read charts and you see these trend lines, they tend to hold up for a reason, because a lot of other people looking at it. But we can see materials. We saw this upper resistance trend line going back to 2024, massive run up this year. Materials up over 10%, runs right into this trend line and starts to pull back in. So nothing too crazy there, but definitely a lot of strength. Consumer staples finally breaking out to all-time highs. Again, they were one of the bigger laggards of last year. They closed the year to date up about 5% at the start of the year. And then they had this massive breakout to kick off the year. And again, like I mentioned earlier, there's been this shift recently towards these, larger cap names, the more safer defensive names, consumer staples. You're going to buy toothbrush, you're going to buy toilet paper, no matter what the market's doing, no matter what silver's doing. But those discretionary purchases kind of, can get put on the back burner. So we're definitely seeing some very clear rotation, while some of the, overheated sectors like energy, that's been very strong these past month or two. I'm going to show a monthly chart here. This is going back to 2013, probably, even for me, I think I was, probably sophomore in college at that time. But long time it took this sector to finally get back to all-time highs. Again, this is a 10 plus year retest area. So have to expect that this area acts as resistance for the time being. Again, massive monthly candle. One of the biggest monthly candles we've seen in energy pretty much since like 2022. But we've also, I apologize to get my dog barking, dog walking by. Again, we've seen similar massive monthly candles in the energy sector, but what tends to follow is, some, reversal price action that follows. So would not be expecting just a massive break because of this candle. You gotta let it pull back in. It's been on a crazy run, and this is a massive decade plus level that eventually, sure, it'll push through this level in time, but I wouldn't expect it to be happening anytime soon. Again, some other sectors that are setting up. Again, consumer discretionaries, is hovering. We're seeing a lot of these sectors that have retested all-time highs start to break out and are just kind of hovering near these prior all-time high breakout areas. We saw that with the small and mid caps. We're seeing that with consumer staples. We're seeing that with consumer discretionaries. So we're seeing a lot of this, a lot of the same setup, which is a very good sign that will eventually see continuation higher. Like I noted here, we want to add to these highs. Like just let it set up, wait for the break of highs, and that path of least resistance is often higher. Same thing with healthcare, same story. Very broad bull flag up here. This dotted orange line, if you can see, is the prior all-time high area. So, it's going to mess around this area until this area, which was resistance, starts to act as support. And that's when you start to see these breakouts to new highs and the sector's kind of off to the races. So most of the sectors, except for energy, are sectors that can very easily break out to new all-time highs and push. When you have an energy sector where you have places like OPEC that are trying to control oil prices and supply and demand, you're not going to see massive breakouts in the energy sector as you're going to see in other sectors where there's not as much kind of control on the product that they're selling. So just a little side note there. Again, only real weakness is really utilities, which is a good sign. We want to see a weakness in utilities. Anytime utilities are flying or breaking out, it's a flight to safety. So we want to see lower highs in utilities. That's the only sector that we want to consistently see weakness in. So moving on to some names and some trades. Again, on my end, been focusing very much on the healthcare sector. Again, this Gilead, talking about a macro setup. I'm going to zoom out to like a monthly here. This Gilead, very textbook, blue sky breakout. Again, this took nearly a decade to set up. Even if we think of like that energy example, the energy chart had all-time highs in 2013. They like retested it, and you can see that first major retest, it pulls back in, and it takes nearly 6 months to a year before it finally breaks it higher. So just trying to show a visual example of a 10 plus year chart pattern. Again, individual healthcare name, very different from the energy sector, but just the timeline of how long these patterns can take to develop before they really break, just a good visual example. So again, for Gilead, we saw this level setting up. We saw this tighter flag forming. So I'll go over to like a weekly here. So even with these sectors, before I was mentioning, when they break out through prior all-time highs, they tend to chop around, and that prior resistance area starts to turn into support. And when that can happen, that's when you finally start to see the breakouts that follow to new all-time highs. So like I mentioned with consumer discretionaries, with healthcare, with small caps, mid caps, all these setups right now, it's just waiting for that break of the recent high after macro resistance turns into support. And that's what we saw with Gilead. And the trade was just very simple, just buying through that high, buying through that 128 area. And for the last 3 weeks, it's just continued to push higher. So on my end, that's been like my main focus, is just sitting in this Gilead and holding it. Earnings are like in 8 or so days. So we'll see if it can continue to kind of have a run up into earnings. It most likely takes them off before that earnings announcement, but that's been the main focus. Other than that, we had, very light trading the past few weeks. We had an alert in NVIDIA, and we had an alert in LIVN last week. So LIVN, again, textbook bull flag. We can see, the support at 60. As it continues to develop, we can see buyers up to 62, which is a good sign. And then we just want to buy through this break of this 64 area. And we got some nice follow through these last couple of days. And then NVIDIA, which again, semis have been on fire, sector as a whole. Think of names like, MU, Micron up nearly 70% this year, crazy run. AMD up, very nicely overall off these, up 30% in the last month. And then NVIDIA has just kind of just been hanging out and just flagging out in this recent range. So, we've traded this a handful of times through this like 184 area in, last year. And then recently we've just started to see this 195 area start to act as the new resistance area. So on Thursday, we had what we call kind of like a screw bar day. It kind of screws everyone, opens up, pushes lower, reverses, closes even, screws people that were long, screws people that were short, very choppy day. And the following day, we had some nice price action, as NVIDIA was kind of running up towards this 195. So we took an entry in it through this like 193 area, but by end of day, it was reversing, basically closing as a doji. No sign to really hold this. We want to see this break and close of 195 on Friday, which we did not get. So we weren't, we're expecting a breakout through this area. We didn't get it. No reason to continue to hold NVIDIA, hoping that it would happen today. So we took the loss, we bought 193, got out pretty much like 191, 1% loss in NVIDIA. It's rounding error, who cares? And then today it gaps down. And again, this 184 is still, for now, acting as temporary support, but really this 170, 177, these are kind of like more significant relative to like kind of the choppy action that NVIDIA has been experiencing. So on my end, again, holding Gilead, LIVN looks very good. Textbook breakout. NVIDIA, we took a shot in it, took the 1% loss, and glad that we did, because with the gap down today, that would have been a 4 or 5% loss. So moving on to some key names that have been very big focus in the market. Again, gold had this massive run up this year, consolidated. And again, with any of these, whether it's gold, silver, whatever it is, stock, index, if you could find entries through all-time highs after it's set up or at least retested, your realistic risk is often much smaller than you're going to expect it to be. The first time blindly buying 4,000 or buying 5,000 in gold, that's people that are chasing. People that are buying the retest are often those that are just impatient, and you don't get that real follow through. But that third or fourth time through those prior all-time high areas are often spots where you can find entries versus recent pivot lows. And it's very defined risk. Now, I don't trade gold. I don't trade precious metals. If you look at, gold and silver are the coolest thing right now. But for the last, since I've been trading since 2007, lower than financial crisis, with gold, no one has really spoken about it. And if we zoom out, let me delete some of these lines here. If you were a long-term buyer of gold from 08 until 2024, so 15 years, this thing moved, best case, if you perfectly traded it in 100% range. If you bought the dead low and sold the absolute dead high, it was 100% return. For most of us, we're not absolutely perfect traders. And this is a reason why we avoid it. I avoid precious metals because they're not moving that much. The S&P is up way more than that in the same period of time. I don't want to get stuck in just something that's, this safe haven, so to speak. But gold did have massive breakout this, in 2025. And again, we're talking about buying things through all-time highs after multiple attempts at resistance. And gold was a perfect example of this. If you simply just waited for gold to break, I'm just going to say $2,000 an ounce, and you had that low, that prior week low as your risk, you're buying $2,000 an ounce, your stop is $1,800 an ounce, you're risking 10%, and you get a double. If you trade gold and you bought this candle, that is amazing textbook trading. Buying it at 4,000, buying it at 5,000, that's people that are just chasing, and that's the people that experience, the extreme downside of when you don't understand technical analysis. So we had that crazy run up in gold, pulls in, has that final push to $5,000 an ounce, and as quickly as it comes up, as quickly as it comes down, 10% correction type day, back to back, and still really nowhere near, macro support. So for those that are in this gold trade, there's a long way before you're really back into, real long-term support. This is just crazy euphoria. But even with silver, again, a lot of these, articles now are hyping up silver. But again, let's look at silver for the last 15 years. Silver topped out at $50 an ounce back in 2011. And for 15 years, it could not get back above that $50 an ounce. So again, if you were buying silver for the last 15 years, you either were riding it down for a massive loss or patiently watching it do nothing for a decade plus, which you got the patience of a monk to sit in this thing. Now, again, through 50, it did break those all-time highs. That's kind of like my main theme for this video. If you're still watching, is just if you like something and it's setting up, wait for that third attempt through its all-time high. So we have all-time high here at 50. In October, it retests $50 an ounce, pulls back in, third time's the charm, breaks through $50 an ounce, never looks back. Again, you buy 50 versus 40, it's 20% risk, but you get the double. You're risking 20% to make 100. If you can do that, do it as many times as you can. But with the amount of articles I was seeing about it, I posted a couple tweets about silver when it was getting very parabolic, where S&P 700, gold 5,000, Bitcoin 100K, silver 100. A lot of these big round numbers are magnets for these different investments, and they act as magnets on the way up, and they become resistance once they've been met there. So I saw this gap up on Monday, I just put some tweets like, if you're unsure what to do, place a stop under 100. It's a massive psychological level. It's going to push higher. Cool. If it can't, this is the area where it's going to fail. And for 4 days, you would have, if you saw the tweet and you were following it, you would have gotten stopped out at 99. You would have missed some of these pushes up to 105 or 110, but it would have gotten you out before the massive 30% gap down. And now this move also is pretty dead. There's no real recovery from this chart in the short term. And just like we saw the last time silver had its little run up, 15 plus years ago, once this run was over, there wasn't new highs for a very, very long time. So you're going to have to expect to see much more chop, much more lower highs. If you think you're seeing $100 a share an ounce anytime soon in silver, Godspeed, because it's this reversion to the mean is always going to, the roller coaster is coming back down. The roller coaster ride on the way up is over. And for one of the reasons why I always avoid any leveraged products, these silver bear and bull and bear ETFs are a perfect example of this. So this AGQ is a 2x leveraged silver fund. Again, they rebalance every day. So if you bought this thing at 400, I can promise you will never see this price again. The only way you ever will see $400 a share again is when they reverse split this stock, because it's just going to continue now to just get crushed and crushed and crushed. It's like 6 months, this is going to be at $80 a share or lower. But again, if you got trapped in this thing at anywhere in the 400s, there's no recovery here. It's just, this thing is in the graveyard. And on the flip side, for those who want to say short silver, and they're like, that was the top, again, like I was talking about it, but again, I'm not going to trade precious metals. This isn't my area, sandbox that I want to play in. But for those that want to short it, and even for me, I didn't look around, but the only, other than puts, which I don't trade options, the only real bearish ETF was this ZLS. Now, ZLS was up 60% on Friday, but this is a stock that is down 99.999% since inception. So a lot of these bearish ETFs, if you ever look them up and you zoom out and you're like, when the hell was this thing trading at $1 million a share, or this one at 50,000, it never actually trades here. It's when they reverse split these stocks, they do a 10-for-1 split, and this thing was trading at $40 a share. When they readjust the price, it's now $400 a share. And you can see 1-for-4 split, 1-for-4 split, 2-for-1. We got 1-for-5, 1-for-4, 1-for-10. Any bearish ETF that you ever look at, this chart, they will always look this way because of the splits. And that's why these numbers get so crazy. It never actually traded at $45,000 a share. This thing probably traded at 50, and it's just been reverse split so many times that the numbers keep getting bigger and bigger. Just like if you look at a name like Tesla and you go to it, when it IPO'd, the thing IPO'd at $20 a share, but it's going to show you was trading at $1 because Tesla has reverse split as well. So this is, even if you want to take the short side of the silver trade and you wanted to buy this 2x bearish ETF, it takes me forever to get back to this price point. If you weren't absolutely perfect and bought it the day before a black swan event and you were still right in the short, if you shorted this thing on when silver was, if you shorted silver the first day that it was at 100, you're like, this is the top, I want to short silver, you would still have lost money. This is where I was trading at the day that silver topped at 100. So if you were perfectly right in a black swan event, shorting silver the first time it touched 100, after a black swan event, you are still break even in that trade. And this is why we do not trade bearish or bullish leverage products, because the daily rebalancing just kills the share price. If you hold this thing for a day or longer, you just get crushed. Even if this is a black swan event that silver has never seen in the history of silver, a crash in silver, and this little move is that crazy silver crash, a 30% crash in silver. This tiny little incremental move is the benefit of being on the short side in this short leverage product. So I can't make it very clear. I hate these products, avoid them at all costs. And again, if you're going to buy silver and this thing's going to ever break $110 an ounce, it's not going to do it the next time. But in years, it gets back up there a third time, sure, take it then. But for now, expect a reversion back to the mean. Expect, some pull in. 3 months from now, this thing is more likely at $50 an ounce, and it's going to be anywhere near, $100 an ounce. So if you're stuck in it, it sucks, but that's why we want to, keep these. You got to have those stop losses in place. Moving on to just some key names. Again, we've been keeping an eye on this Tesla. Again, it started to break the trend line that's been holding since April. Not the best sign. For now, it seems like potentially there could be this rollover and retest this 360 to create some macro support. But if that is not the case and Tesla wakes back up, really for right now, it's this break of this 450 is the key area to have this trade kind of turn back up. Next up, we have this SMCI. Again, it's basing out down here, looking for this downtrend breakthrough is 32. AS, again, we've talked about this name more times than I can count. Just been flagging out for months and months and months. We only care about this break to 40 if and whenever that time comes. Now, a few weeks ago, we had some news from Trump about limiting interest rates on credit cards for a year that he announced, again, didn't implement or couldn't demand, but just asked some credit card companies to do it. We saw a lot of these credit card companies gapping down on that news. We saw some credit card companies jump on board and offer this to some clients. I got some of those offers myself. I saw it in real time. And this Amex has been in a very clear bullish channel. But with this gap down, when this news came out, it's since started to test the support trend line and start to form what could be more of a topping pattern or the start of a breakdown stage. So if you are in this American Express, looking for, the exit seems to be the move at this time. It isn't like rush for the exits, but if you see a break at this 340, could be probably time to, take the win if you're in it and avoid the rollover lower. Now, some of the other credit card companies, Visa, MasterCard, Capital One, have all been doing, somewhat all right. Visa, gapped down on the news, but did base out. We had this alert for 330. So this is kind of more macro support in the name. It's been holding up. Nice little breakout today. So it seems like they're kind of shaking off that news. MasterCard, very similar story. Again, we were talking about kind of last week, this, MasterCard at support, and it goes either way. Either it breaks up through support here or it breaks down, kind of a coin flip here. For now, it's been pushing higher. And COF, kind of similar with American Express, just in this breakout channel, gaps down on the news, closer to support, but hasn't broken the bullish channel for now. So keep an eye on the credit card companies. Again, it wouldn't be a dire rush to get into them. If you are in them, it's just knowing the key spots to get out when these trades break. Some other big names, again, this UNH gaps down on earnings, definitely big avoid for now. Again, this prior support area is now acting as resistance, not a good sign. More than likely, we'll see probably a push closer to these lows before we see any, real run back above, these 380, gap fill, these gap fill highs. So again, very big base here. UNH has definitely been taken to the woodshed this past year or so. Not the time you want to be getting into this name. Let it shake out, let it push lower. Very much so a big avoid in that space. This triple R textbook bull flag through 64 tests it the last couple days. Not ready just yet. Let it pull back in. Still setting up very nicely. Just need some time. MEDP, similar situation. 620 breakout, not ready yet. Earnings could be the catalyst. This MHO 140 still set up, looks very good. This is really the real ATHs 125. Just fly, kind of basing out here. CAH was another blue sky breakout from last week. Again, we were talking about a lot of these healthcare names being strong. Earnings are on Thursday, so you definitely want to make sure you're out of this name by Wednesday if you are in it. Raise that stop to break even, but nice blue sky breakout. Looks great. STE, feeler entry triggered today. Blue sky breakout, they're 268. Does have earnings on Wednesday. So most likely we'll have to get out or wait till after earnings. But again, a lot of strong healthcare names out there. This is another one of them. Again, Hood, we talked about this a few weeks ago. There's easy and hard times with particular stocks. Again, Hood, visually, this green line is like the easy time. Name is trending higher, higher highs, higher lows. This is a nice breakout through all-time highs. And then you have the tougher times where you have lower highs and lower lows. And this is when you want to avoid the name. Big 10% gap down or sell off today. This is not the time you want to be jumping into Robinhood. You should expect this breakdown stage to continue for the time being. We've seen this in Microsoft. A few of the names we'll get to in a moment. But this is not the time you want to jump into names when you see these very clear lower highs and lower lows. It's like, oh, this is going to be low. Give it 2 or 3 months. But more likely to be at 60 before you're going to see anything above 140. So you want to be able to spot these very key stages and knowing when names should be avoided at all costs. And Hood right now is for sure one to avoid. CYTK, our buddy Kevin has been looking at this name. Again, very textbook bull flag forming, holds the low of 62 today very nicely. Earnings aren't until March. So keep an eye on this 66 breakout versus 62. Looks pretty good. BYD, gambling, casino and gambling stock, very clear resistance at this 88 area. We can see it tries it, not ready yet, pulls back in, and waiting for that next attempt at this 88 area. Earnings are on Thursday. Nice base breakout forming in Wingstop through this 280. Earnings aren't until end of the month or mid-February, so we got some time here. Key support at 260, still holding up. Some other notable earnings from last week. Again, Microsoft, big gap down again, like that Hood. So Microsoft is in a massive stage 4 breakdown again. Microsoft has had a phenomenal past few years, but talking about the easy and hard times. Easy breakout stage, higher highs, higher lows. Buyers are in control. Very clear, very clear breakout stage, topping pattern / base, stage 4 breakdown. Avoid Microsoft at all costs. until there's a retest of these lows, or we start to see this similar basing form, into this gap fill area. So for now, avoid Microsoft like the plague. Anytime you see these very clear stage 4 breakdowns, just avoid them. We can see, again, we're talking about these stages. Meta was one that was in very similar stage 4 breakdown. Did have a massive gap up on earnings, so it finally started to push out of this stage 4 breakdown. Again, you can see, I know for some people when you don't understand the 4 stages, it can be hard to spot, but I'm going to try to visually show it here. So again, red breakdown stage, often referred to as stage 4. That's where you see lower lows and lower highs. Then a stock has to start to form a base, or a stage 1 base, where it trades horizontally. When stocks top out, they do that at highs. We can start to see this horizontal consolidation, and then the earnings catalyst pushes it out. So now that it pushed out of this, now it's starting to base out again, and you still need this thing to pull back in, set back up to work its way back to these all-time highs. But still very tricky price action in this area. It's still very early. This has been going on since October. So these patterns take many, many months to develop. And that's why, when you start to see these breakdown stages and bases, this isn't like you need to get into it tomorrow, just keeping an eye on it for when it sets up, weeks or months down the road. Now, again, we've been talking about this rotation to some of the larger cap names lately, with some of the rotation out of like the higher beta tech names. McDonald's, Dow 30, super strong, massive bull flag forming through these 320 all-time highs. Big fan of McDonald's. If you are a big fan of McDonald's, keep an eye on that 320 breakout. Definitely don't need to give it versus 300. We can see this 310 has been acting as support. And like some of those prior examples, like Gilead and even GOLD, this McDonald's has had many attempts, 5 or 6 major attempts at this 320 in the past 6 months or so. And it continues to form higher pivot lows where buyers are just stepping up. So eventually, either the sellers have to, the sellers get pushed out, or buyers push it higher. But with earnings in a couple of days, definitely keep an eye out on this 320 breakout area. Merck, again, our buddy Chad Lamb has been looking at this name. Healthcare has been very strong. He's looking after that 108. Nice entry there. Textbook breakout through 112 if you're in it. Very strong name. Still working its way back to these all-time highs. And again, if we're talking about these stages, this is kind of my key point recently on this part of the video, but we can see, this is the breakout stage. Here is the topping stage. Higher, I'm going to change this to green so it's easier to see visually. But again, you can see when you can spot these stages, it becomes very easy to know when you should be looking at names and when you should be avoiding them. Merck 2020, for 2 years, Merck was very easy to stick with. Spend half a year or so kind of topping out. Spends a year breaking down. Change this to red. Very clear stage 4 breakdown. Not the time you want to be involved in Merck. And then you start to see that new base forming. Stage 1 base. And now you have stage 2 breakout. So when you can find entries in Merck, it's more than likely going to continue. I know we got a lot of lines on here, but you can stay with me. Breakdown stage, base, breakout stage back to all-time highs. And, this 130 is going to be the resistance area or the target for this name pretty much by year end. Even if we look at like biotechs, for example, we're going to see the almost identical chart on just a bigger time frame. So you can see breakdown stage for like a year or two. massive base for 2 or 3 years, and then a year of a breakout stage, and now it's topping out again. So we see these very similar patterns happening over and over again. And when you can spot them, it's much easier to take advantage of them to your benefit than, being at the mercy of the market when you're, chasing silver at $100 an ounce without a plan. So we had a member looking, I've been at this NBIS. And for me, if I had to trade this name, I'd just be waiting for this 100 breakout for now. Next up, again, Netflix. We talked about why we want to avoid stock splits back in November. Netflix split their stock to make their stock appear cheaper. And since then, this is again why we avoid stock splits. It has done nothing but sell off every single day since then, and is now at macro support, where if you were to short something, shorting this break of 82 versus 85, I don't short, but pretty tight risk short here, as any of these stops, everyone who's been long this thing, if they have stops here, this 82 area is going to be where stops are going to get run. Apologize for the yawn, but expect to see this 82 area break in the next couple of days, even with the earnings beat. Did nothing for the name, just a lot of downward pressure. And last but not least, again, talking about McDonald's, some of these Dow 30 names, this focus on mega cap names recently. Walmart, consumer staples name, pushes through new all-time highs today. Again, consumer staples breaking out as well. So if you're looking for some names to trade, healthcare, consumer staples, Dow 30 names, that's kind of the space to be in. Again, these silver and gold thing, these trades are dead. It's over. Even Bitcoin's getting, pretty. Again, we don't trade crypto, but we're talking about these stages. Massive breakout stage for 2 years. And now you have a massive, let me delete these lines. So massive breakout stage, and now you have, pretty big breakdown stage forming. Textbook, massive weekly bear flag and breakdown to the downside. So for those in Bitcoin, I hate to break it to you, but if this 74 area does not hold up and this area breaks, really not much support until 50. So this is definitely major inflection area. This 75, which for right now, maybe given how much it's sold off recently, could bounce. But if there's the longer this thing stays below 100,000, the much more likely that this thing goes to 50 before it goes anywhere close to 100. So not a good space to be in. Again, that's where there's kind of that coin flip with the market, where there's a lot of weakness in crypto, a lot of weakness in precious metals, where the market just doesn't care. S&P was barely 1% away from all-time highs. Big picture model, which very closely mirrors the price action of the Vol index, crushing it. Models at all-time highs. So what we're in, for those that are in big picture, we're sitting pretty. We have very defined exits if we need to get out. Market's super strong. Individual stocks have been a little choppy. Definitely a lot of volatility out there. So passive side, nothing really changes. Active side on my end, been very cautious or very tight with risk, and just sticking with, finding the one or two winners and just letting them rock. With Gilead, rather just sit in this, let it grind higher than getting chopped around some other name. So hope this video was helpful. And if you have any questions, just put them in the comments below. I'm going to try to go over them next week. Thank you.